tonight, and we'll get going into the intros and who everyone is. So we had a great weekend last weekend. I know some of the team, a few people were at with Brad Sumrock up at his event, and thank you guys for joining there as well. And then a few of us as well, were down at the 10X with Grant Cardone, another great event. Just a lot of high energy, high vibrations going on at these events. A lot of connections, getting into proximity. And the reason I mentioned a lot of people is, is like where to start, how to start. And the biggest thing for me is starting with proximity. Just be involved, be close to what you want to be doing, and surrounding yourself around the people that are doing that, right? So that that starts with this. We talked about some other other groups have their things to follow. So we do a lot of stuff with that event, and at 10X was with Legends and Alex, and he did a call on Monday post 10X event. So it's just a great group to be around and continue that process, right? This is our team, and we're not going to go into everyone's details here, but you get an idea. We have a team that's growing. We've actually got a couple, which was people missing off of here. Brad Pickett should be on here as well, coming in as our lead of deal finding, deal acquisitions processes, and working with people on that side. And we also have Senate Eskridge. We actually have two others, I guess. Senate Eskridge, which is going to be leading our massive multifamily movement, which is an educational platform. And his wife, Carrie Eskridge, is going to be leading our events planning and processes. So we'll get them on the board here for the future opportunity that we do. So that's a quick intro. We'll be sharing in the chat, and one of the things we always like to do as we get going, one is a disclaimer, not that we like to, but I need to, that we're not CPAs, we're not attorneys, we're not lawyers, we're not any of that stuff. We're not your accountant. We're here to share, what has been our experience and our knowledge. And from that, take what you want from here, and use it as you wish. But it's only our knowledge and our experiences here that we're sharing, and not advice directly. Let me think. The other is anyone that's new to webinar, to this webinar, drop in the chat, new, fresh, first time, and we'll get connected with you. Trevor will be connecting with you, or Jasmine from our investor relations teams. They will help get you into, make sure we get you guys all involved in the right areas, the right places, depending on what you're looking for, what you're doing in your journey. So that's what I had to get started. I'll turn it over to Shariah, I think, right?
Yep. Thanks, Mike. Appreciate it. So a little bit about the massive beyond the team, and what type of assets and asset type and asset class that we buy. This is one way to kind of explain. It's looking at the value chain of the real estate. We do buy land for new development. Sometimes we'll buy land just to the entitlement, or we'll buy land to go vertical right away. So that's that. We also do value add and Class C and also Class A assets. And we'll talk about the locations. One of the things that we really ask ourselves is that, just because sometimes number goes around, if the skill set is not within our team, then probably we're not going to do it. which is why we are pretty clear about what we are not. Sometimes doesn't have the skill set, so we partner with other local partners, so we can grow the partnership and grow with them, and also bring a lot of know-how into the project. So that's our partnership model across the value chain. Mike, let's go to the next one. Okay, thank you. So I shortened that up. So those are all the markets in green. Those are the markets we own assets. We have closed our first asset this year, this month, a couple of weeks ago. Thanks to all the investors who trusted us with the project. We bought the land for entitlement only. That's for the phase one. We're going, that work already has started. We have 3 more in the pipeline. And so we have 2 506Bs and 1 506C coming up. And Tampa and Phoenix area are our market that we don't own assets, but we're looking into it. And
Yeah, and
we
Tampa, we're actually working also with some people on the South Florida side, so it's coming along.
Thank you, Mike. And same with Arizona. We partner with the team for a project in Dallas. They are from Phoenix area. They have a decent portfolio from there, which they exited. And all of a sudden, without being in Phoenix, we bring a lot of know-how within our team via the relationship. Right. So yeah. So we'll talk about how we partner, right? And I'll spend a couple of minutes on that one. So one of the things that we believe that multifamily, especially in the commercial sector, it's a team play. And within the team play, sometime somebody will run out of something. So having clarity about how we partner, it's very important to us. So when a deal shows up, we can help with the deal sourcing, which is underwriting. We can build the team resume with our resume, and we can bring our attorneys to do the PSA, and we negotiate contract on behalf of our partners as well. And post contract, if it's the due diligence, contract to close, and also the cost needed, and we also bring that up. Mike, I think your slide went away. Thank you. So we also help with that, and especially on a large ticket item, 10, 15, $20 million worth projects. Earnest money is pretty huge. We bring in the earnest money from our pocket, and we kind of continue the project. We also bring in balance sheets and liquidity and experience for the loan if it's needed, and equity, that kind of comes with it. And on the asset management, and depending on the project size and also the type of the intensity of the project, we'll sit into the asset management as well to bring in the advisory and the property management. So larger the projects, we are more in the front line. Smaller the projects, we rely on our partners as we go. Now, again, we believe that those are all the tools we have in our toolbox. So depending on what the partners need, we'll design the equation that way. What it resulted, last year, we made about 22 people GP for the first time. Same here as the goals as well. But in general, we accelerate our partners' growth. For operating partners, we deburden them by taking on the burden on us for the debt, liquidity, and also some equity. And also if partner with the equity partners, then we give them all the time that they need to build up the due diligence process or the work process from the investor relations perspective. And we take on the burden on us to source the deal, underwrite the deal, and bring investable assets almost at a monthly basis here. So that's that. And let's go to the next slide, Mike. Thank you. Sanjay, I'll pass it on to you here. I guess you can talk about all the things that are going on.
Yeah, thanks, Schreier. Again, just to reiterate, some new people joined. Disclaimer, we share our journey and what we're doing. We're not giving in financial advice, tax advice, or legal advice. We're not licensed in any of those areas. So, join our journey with us and come more the merrier. So along that line of thought, this is our deal tracker, deal flow tracker. On the right is the spreadsheet that we track our deals currently in. All the ones in the gray here are the ones that are archived, deals did not work. And then we actively are underwriting deals, multiple deals in multiple markets, again, with our a lot of partners that we have that come along with us. So currently we have 3 deals under contract in Dallas, one in Dallas Fort Worth area, one in Atlanta that we're partnering with somebody, and another one in Houston. LOI pending on 4 in Dallas and Houston area, and underwriting another 12 deals. Really excited about the North Carolina market. We're looking at that and some very interesting deals there. Other activities, we are actively working on a fund, the documentation, the legal paperwork. So, so that we have some cash available on hand to go after the deals as those become available. And of course, the coming soon is massive capital mentorship / education platform, as well as the events that we are planning on and putting it out and putting forward. So really look forward to this. Next slide, Mike. Thank you. So as Shar mentioned earlier, we closed on this deal in Georgetown. We have boots on the ground there, a couple guys, Andrew and Rick, amazing guy, like them, really love them. So just closed on this, closing out the raise for this. Our investor relations equity team did a great job on raising on this. So this is a phase 1 going to the entitlement. Once the entitlement is complete, we will go to phase 2, which would be a project on its own, and we'll move forward with that. Next slide. And then the 3 projects that we mentioned, we're currently actively raising for a 506B project here in the DFW area. It's a 506B, so this call is wide open. We don't share the details of that actively. Another one that we are just getting ready to start the raise, lining out all the documents and paperwork. So that would be coming out later in April and May. Again, another 506B, so not sharing the details here. And right after that is the X space. So we're really excited about this X space. This is a luxury garage and co-working space combined together. So there's a concept that already been demonstrated in Austin area. Our partner PSC Properties, they've bought a couple of the condos. They call them condos there, and next they're looking to do that project in Houston. So we'll be bringing that to the market for a raise this week. Next week we're closing on the land, and then we start on the equity with all the paperwork and stuff in place. So towards the end of May, June, that would be on full speed active coming out, and just love the concept. So look forward to that, and we'll talk about that here. Next one. So here, I guess that's about massive capital team and projects, our philosophy. So the topic of today, underwriting. We have talked about a little bit about the underwriting of the project, and today I think we're focusing a little bit about the market, underwriting in down cycle. How do you underwrite a market? What do you do, right? So the 4 key pieces for that: the lending environment, and as soon as you talk about the market, anything that happens in the market can impact that lending environment. So it's a big piece. Equity availability, property strategy. Again, how the market is behaving changes the property strategy. And then, of course, the location strategy changes by the market. So I'm going to talk a little bit about the location strategy here, and hand it over to Schreier for lending environment. And Mike, if you want to talk about the equity, I'll hand it over. Have Schreier hand it over to you. So on the location strategy, we're very big on growth, demographic, so population and income. So those are key metrics. As you saw on the graph, little United States graph earlier, we're very big on certain markets. So what is it that drove that for us? So looking at the Texas market, the population of Texas market it has been growing and growing for last 6-7 census. So that's a 60-70 years of population growth. And as the population grows, the type of people that move, the young people, they have kids, the universities are great. One of the largest universities in the United States here in Texas. So that demographic, the population, the huge part of your location strategy for underwriting. Do I care when there's a trend, 70-year trend, population growth trend in Texas market? Do I really care about the down cycle? Absolutely not, right? Like we're active, we're bullish for Texas markets still going. Similar things we see happening in those other markets is there. And of course, the income, that's a huge part. Even though people are moving, the population is moving, what type of income is that bringing? Yes, we have all heard California, New York, Illinois, those states, people are moving to, Arizona, Texas, Florida, some of Carolina. But interesting fact that, Shrad brought up, we discussed, from New York, the higher income people are moving to Florida, and the 150 to 400,000 or so income people moving to Texas. So, differentiating that and looking at that key piece of information. So that's kind of the looking underneath the data, what type of population, what type of income it's moving. And for the location, taxes and insurance, sort of out of our control. Yes, we can plan for it up front, but as we are seeing right now, insurance is just skyrocketing. Never planned for this 30 to 50, 60% increases year over year. But for a location, the coastal locations will have higher increases. The inland locations will have smaller increases. So just those type of things for location strategies go into your underwriting for a down cycle. And we're more cautious for high insurance areas now in a down cycle because cash is that much more important. So Shriver, do you want to talk about the lending environment there?
Yeah. Thank you. And so those kind of, okay, before I jump on that, the population growth and the income, that is really interesting about people are moving into Texas, moving into Florida, but what income bracket that they're moving into. That is kind of really interesting. And also secondary thing is when we take a look at population growth, we don't take a look at gross population growth, which is the headcount increase. We look at adult migration. So total population migration minus the newborn. And then we take a look at it and we call that a population growth. That's at least our definition. Interestingly, Harris County is one of the largest counties. The growth rate of the population within the Harris County, including the newborns and excluding the newborns, still net positive, but there is a pretty good delta between those two. So it's interesting data. Back to the lending environment. For us, lending environment changes depending on the market cycle. So as some of you guys may know, we have majority of the thing that we do at a repeating basis, we try to come up with a decision framework or decision priority. So we use that quite a bit for lending. So when we look at a property to buy, we don't ask is the asset worth buying and then build the financing and the equity and the team. That's not the way we are looking at it. We back solve it. So we said, okay, we understand what the cycle at, we understand what the financing would look like, and then let's see what asset fits into those buckets. So it's easier for us to look at that way. On that note, we follow extremely closely all the lenders, especially the big shops. They have enough data to look ahead 36 months, 46 months out, way beyond what you and I will see. So listening and hearing them and reading through the line what they're talking about is very important. What it means is that we pay attention to the direct lenders. We pay attention to the CEOs of banks, JP Morgan and Citibank and Wells Fargo, those rather listen to the brokers, right? Brokers are the intermediary, they get it, but not all the time we're in tune. So we pay attention to senior brokers who have been here for a long time, and brokers, they do a lot of deals and they are direct lender to some of the other institutions. We pay attention to them. And we also try to stay close to the market rate. And I think we are the handful of team we're open in the market talking about buying in a loan assumption is great. but at the same time, it's an issue if the cycle time is pretty quick, because when we buy, we are paying at a lower interest rate, but when we sell, we have to sell at a high interest rate. We have to do the work just to sell and then double work to get profit, right? That's that. Mike, this, yeah, thank you. And also the feds, right? Sorry, Mike, the other slide before, please.
Oops, sorry. Sorry,
Thank
guys.
you. Yeah, thank you. And number 3 on the top left, we're talking about the listen to feds, right? Our underwriting assumption, what Powell talked about last week, which is 5.1, 4.3, and 3.1% of the feds rate. Then depending on the project type, we add the spread in between, and that's our underwriting model. Yeah, people will debate 5.1 versus 5.2, 4.3 versus 4.1, but more or less it should fall into that bucket. So that's that. So that's how we take a look at it. I'm sharing with everybody how we underwrite, how we look at the lenders, and then we couple that lending strategy depending on the location strategy, because not all location made the same. So being that, Mike, what's your thoughts on the equity?
Hey, thanks. We says in here, and we kind of actually chase equity in multiple ways right now, and we did before, and it's even more important now than it maybe was earlier, right? So many people may or may not be aware, like, or familiar with what's called the capital stack. So your capital stack, is you have your senior debt at one point, and then you have something in the middle, which may be mezzanine debt, or it could be institutional money, a preferred, or like a private equity check. And sometimes those come in as like limited partners, or they come in different positions. They come in maybe as strict debt or as an LP. And then at the top, or part of that, then you have the retail equity, retail referring to kind of the public equity, where we're raising, equity from, everyone out there, everyone on this call, everyone, in the communities that we're raising equity from. And you need all of these in order to really make sometimes the deal work, is a key part of the underwriting, because there's different costs for each of those. So the senior debt is usually your cheapest. Mezzanine debt or private equity then is a little cheaper, and then retail equity is usually our most expensive. So the more we can limit that, it helps us all in two ways, right? It helps us to not have, it helps us to make the return better for the retail partners that we bring into deals, and it helps reduce the number of retail partners that we have to bring into every deal. So it ends up becoming a win-win the more that we can, fill in those gaps below and have a higher return for the partners on that. And the one thing with sometimes the institutional or that middle money is, okay, there's rules and guidelines, but man, those rules and guidelines are things that we should all be doing anyway. And there's not really much different than rules and guidelines that are there for the senior debt. So it really is almost, sometimes it's more beneficial having that than not having it. The opportunity right now, I think sentiment in general is mixed, and really depending on where you are in your strategies and your kind of capital raising processes, it's going between a 506C and a 506B, meaning 506C, I can go and advertise and go to anyone, and I really don't have any rules other than they need to be accredited investors. Gets out there, gets a lot of attention. You can get a lot of momentum with that. The 506Bs are great. You can go to, some lower minimums usually, and you get a chance to bring in people that don't always get to invest, and it lets us talk, get into different groups of people that we wouldn't get into with the 506C. So those are really just a few things I had. Sanjay or Schreier, Sanjay, I'll go back to y'all on any other things you may have comments on those pieces as well.
Yeah, I can add a little bit more on the institutional checks as well, right? So building up what Mike was talking about, we try to come up with the optimal solution to solve a problem, right? It's, if we can bring in retail, all will do it. And if we can bring in pref and a blend with the retail, we'll do it. And also, again, this is the downturn, right? So what we'd like to do, we'd like to listen to folks and pay attention to them who have a lot of data point and they have invested, right? And that's why we pay attention to the institutional checks and what kind of a feedback that they're providing, especially why they're providing. And I'll give an example. There's a family office, there's a family office that we met 6 months ago, 5 months ago or so. They have two funds. They have $120 million of debt fund and $40 million of equity fund. They interviewed us rigorously. We interviewed them. We practiced. And then after the practice, one of the nuggets, we're talking about it last week when I met them in IMN in Dallas, is that what asset class we should not buy for now. So I explained my thought on, hey, I don't know what not to buy, but I felt like anything that goes about 350, 400 units or so, especially on this B minus C area, so which is in a softer market, it is rough in today's market. And he goes, yeah, I'm looking at the portfolio and there are two assets from the portfolio that are not doing good out of like 30 some odd assets, and both of them over 500 units. So like, okay, we know. So data tells a lot. To what they say, it's very important. So we work with about 6 or 7 different groups like that, and they give us a lot of data points. So a lot of institutional checks are out there. The money is ready to deploy it. It's just finding the quality projects for money to come in. That's that. Back to the property. Kind of go ahead, Sanjay.
No, just to kind of add that, tie it all together, what's different in down cycle versus an up cycle, right? Like in an up cycle, the cap rates were going down, but here, you look at the cap rate for our pricing and everything else, but in some ways we don't care as much about the cap rate. But it's all about this financing and availability of the lender, the equity, the institutional. That's a big deal in down cycle, right? That's why that's in 2 boxes there. Location strategy changes a little bit as we look at the growth and on underwriting, and then the property, right? So go ahead, Shrai. I'll let you talk about the property as we tie this together.
No, thank you. I forgot that we're talking about down cycle. So down cycle, again, the lending is the underlying foundation of everything, right? So lending, we got to be close to it, and the equity. When the market is up, when the stock market is, everybody's making it. Hey, yeah, I got some gain. Let me take it out and redeploy it here so I can offset my balance. I can't even finish counting how many of my friends make millions in crypto and they won't even buy everything in real estate just because, right? So we also manage on a down cycle, if someone is taking a 20% hit in an equity market, and that's the majority of my portfolio, it's tough to be objective about it and say, hey, buying stock is like Russian roulette, right? I don't know anything about anything. I'm going to buy it because I feel like it. And then I take that money out and redeploy. It's tough, right? Sentiment matters. And once you tie everything else up, we take the lending, equity, and the location put together into a property. And we try to, going back one of the slides, we talked about that, we buy across the value chain, land for entitlement, land for construction, Class C and a Class A. That's because in a downturn, just having one tool in the one way of cutting every single thing, it just doesn't work. So we need to add flexibility to go through the cycles. And that's why we do it across the value chain. And we also pay attention to the spread between asset classes. Class C in Houston is not the same as Class C in Denver, not the same as Class C in Carolinas, and Class A is a similar pattern. And the spread against the location, spread against the assets, and the asset type of the project type. And then last thing what we do is that in a down cycle, we don't want to learn. We want to repeat. And we don't want to find out something new. We want to stay closer to the team. We want to stay close to our knowledge. We want to stay closer to the proven ground that already been proven down. Nothing ventured out, right? No tertiary market. And secondary is good if you have data point. If you don't, then no. And if you are from Texas, hypothetically, I'm partnering with folks in Seattle. buying some asset in Washington, DC, right? We are avoiding all those newness as much as we can and keep repeating what we already know. So that's not that. So now before we get to next slide, so next slide, what we're going to do, we're going to show and showcase you in a case study, right? For us, we can share what we are doing. So we'll show you a version of lending, how that ties into the equity and the location and to the property, right? So we're going to go that circle, and the case study will be in Houston area. And and all the assets are more between 250 to about 350 units. And those are all class A's. That means less than 10 years old. So that's the context. So we'll take everything else in, and then we'll get into that. Okay, what does that mean? How do you make a decision, and what happens, right? Sounds good on a paper, at least on theory, but let's get to the application of it. Mike, show me the next slide. Just
Yep.
Thank you.
Can I jump
So
in second?
please go ahead. Yeah.
Yeah, so I'm gonna actually, real quick, jump out of here, and I'm gonna share something else, because I'm sorry to steal your thunder, but I also want to cover something, because sometimes we run out of time, and I want to share. So I posted in the chat, so take a look in the chat. I posted a couple of things. One is our portal, the investor portal, for people, if you want to sign up, it'll help. You can keep closer with us. From there, we also, are tracking how we're connecting with people and stuff like that. But also I wanted to share is our, the deal finding. So this is our website. You guys see on the website?
Yep.
Yeah, so in the website, and we maybe will add another button up here. But also, so to join the portal, we actually will have here, you can join the portal. But we also have under resources is submit your deal. So we have a lot of people asking, like, how do I bring a deal? We're talking about partnering and things. So if you want to submit deals, just come here to submit your deal, and it's going to take you to a form. You can submit your deals into us through this form, and we'll be getting them in there. The more information you share, the higher the priority comes on it, or the more the more we can understand about it faster, the quicker we can get through it. So it asks a few questions through here. Bring in the T12 and the rent rolls and the OM if you have it. There's a place you can save those, because then it lets us pull it into our underwriting and everything in Red IQ. So again, just come to our massive www.massive.capital website, resources, submit your deal, and you guys can put your deals in that way. Okay, let me go back to the other share. Thank you. Sorry, Sherrod, to
No, it was good, Mike. Thank you.
interrupt you there.
No, that's good.
But I want to be sure everybody has a chance to find how to submit deals, because there's a few people in the chat sending deals over and these. So okay, are you back to your slide?
Yep, sounds good. So let's go to the next slide. Okay, so this section we're going to break it down to Houston, and we're going to focus on the revenue. One thing, if I have to say, the multifamily, it's a revenue game. It's never been a cost game. That means we got to be revenue leader and cost optimal. It's not, we don't have to be the best in the class on the cost to win a multifamily deal. So anything over 70 or units or so, I would say cost optimization, that's where you're at. But the revenue has to be there. So we start our underwriting with the revenue. So on the left-hand side, the case study, it's a Houston. Tools, we use Red IQ. I'll give you a little bit more Red IQ, what happens. The data is all from our database. It's underwriting, and so we'll give you at least an idea. So folks who live in Houston, you may have sorry, I kind of typoed. So at the top left one is Uptown Med Center assets, and then top right one is in Sugar Land. Bottom left one is in the Cypress area, not in Sugar Land, and the bottom right is in the Galleria area. So those are our analysis that we do when we underwrite. This is like a preset. Every time we get a rent roll and T12, this is the analysis that we do. On the snapshot, we take a look at the growth of the revenue. That means what is happening. So on the Uptown, on the Med Center, this is a brand new property, about 2.5 years old. It's leasing up. what happened in October, November, December, and January, the lease up pretty stagnant. So revenue is there, but the leasing up becomes tough. At least it's the tough. Then we ask the question, okay, it is the case everywhere, at least for a class A or not, right? And then we went to the top right. This is the asset in Sugar Land area. They bought the asset a year and a half ago, and they could not turn the asset down. So in the Sugar Land area on a class A asset, that's a good operator, but the net revenue, which is the light blue, base rental revenue is slightly ticking. Right, so one we saw stagnant, one we saw it's going down, and two heavy hitting areas. This is right by Telfair area, the folks what's one of the expensive sought out areas, I would say. And bottom left, it's on the northeast side of city, now Sugar Land type 1 mine, and it's in Cypress area. And existing assets, existing like about 3.5 years old. So they're going through second rounds of lease up, but take a look at the revenue. It is steep. It's going down a little bit, but and not as steep as the Sugar Land area, right? So it's flat, steep, and that. So brand spanking new, you're flat in a med center. Then Sugar Land, if you have a 10 years old asset, you're really having a tough time on lease up and asking for a premium if the operation team is not there. Let's say I'm operationally great, which is my concession. I fought for it. Then I get the bottom left. I'm still on a downward slope. So if you take a look, the bottom left, top left, the matrix, take away one, it will take a bit longer to lease up. That means when we underwrite, and if you're going to the value add, if we were to say you would take 6 months to lease up X amount of units, now is 12 months or 8 months, right? So that's how we underwrite it. Takeaway two, it's the next 12 months it's all about retention, not rent growth. So if I take a look at the top, on those three charts that I show, stagnant, downwards, and downwards, if we were to buy it, let's say price, everything else is right. What are we doing? Are we leasing up? That means, am I keeping the tenants into our property? Or am I gonna go do that plus increase the rent? So in general, in the Houston market on a value add asset, it's all about the retention of the existing pricing that we have. Is not about the rent growth, and the other one is going to take a longer time to get out. And then what's on the other side? On the other side is the bottom right in the Galleria area. We recently underwrote a property, and that's what it shows, that the revenue is in general growing. Right? Even though the vacancy, occupancy, whatever the case might be, but the value. And that also true for another asset that we take a look at it in the northwest side of it. So in a class A or of a lifestyle type product, extremely premium lifestyle, they still have rent growth. So when you put all the data in together into one spot, the question is, all the theories that we saw on the other slide, this is what it comes in. Hey, in Houston area in general, you'll see that in Dallas area as well. The next 12 months, it's about the retention. The lease up by design is going to take a little bit longer because we're going to compete with others. And the last one is that lifestyle product, they still have a rent growth, not as steep, but still have a rent growth in there. So that was, so that's that. So Mike, can I share my screen a little bit, if that's okay? Thank you.
Yes,
I'm
you
going to
can.
share
Yes,
my
you
screen. Thanks.
can.
And then as we, again, our thing is we are big on data and plus what we do. So this is all the assets that we underwrote this year so far in last 90 days or less. As you can see, we're in, so control shift. So we're in Houston area. We have a cluster of properties that we underwrote. We have a cluster property in Fort Worth, then San Antonio, especially in the I-35 corridor. We have Phoenix area, we started, and Florida we started, and we also building a cluster in North and South Carolina as well. So, and Denver. So those are the markets that we underwrite, and we use a platform called RateIQ. It's that here, and we have right now, I think we started using that, what, 3 months ago, 2 months ago, something like that. So we added 99 projects or 99 different properties that we have in our database. So when we were to go back in and run analysis, we have rent roll and T12s and the patterns built into this database. So we're building our own database as well. And that's where we shared some of the information. And the last but not the least, this is the secret one that we have. This is our own internal database of understanding It's our force ranking of what county to go and what county not to go. And we ranked everything else in. This is our proprietary thing. So we have every single county in the US we downloaded, looked at some force ranking, anything above 100,000 population, we ranked it. So as you can see in the Michigan area, it's tough, except Oakland County, Macomb County, Kent County. And we have that for all the other counties in the US as well. So we use those to make sure that we bake them in to our model so that whenever we underwrite something, it is backed up by data, not rather, what we see on a typical education or typical, the model that we kind of go through, right? All right, so this is about 48 minutes. We shared a lot of bit and how we go about underwriting in a down cycle. And Mike, or anybody else, open for Q&A.
Yeah, why don't we drop the slides and let's go to Q&A so we can just see everybody. Unshare, I mean, unless you wanted.
No, stop sharing.
Stop sharing. There you go. There you go. So let's see what questions everyone has, like about capital stacks, comments on capital stacks, comments on underwriting areas, underwriting regions, underwriting other things, questions, comments.
And if you use the reaction and raise your hand, we can unmute you, or you can type it in the chat.
I think, can you guys hear me? Am I already unmuted?
You're already unmuted, man. I don't know we could keep you muted, sir.
Thank you.
Go ahead, and then we'll get to Madeline next.
I wanted to ask.
Introduce yourself, because you're in here as iPhone, so nobody knows who you are.
Man.
So you need to update your info so we all know who you are in the future.
My name, Mike, I definitely will. My name is David Walker. I live in Los Angeles, and forgive the iPhone tag. I literally rushed to get in. I thought I'd be late. But I wanted to see what you guys' appetite is for deals in Los Angeles, specifically in West Hollywood, Santa Monica area, West LA, basically, because there's a lot of inventory in West LA. But I know that rent control and different things like that have concern for investors. But I'm looking to go where people are afraid to go. So I want to see what you guys' thoughts are. And by the way, Mike, I sent you a deal. I'll put it through your portal. I know that line you gave was for me, but I'll put it through your portal.
No, that's cool, man. I appreciate like your tenacity, your perseverance, your energy and everything. So I love that. I'm gonna let Shrier Sanjay take that question. One of them.
Yeah, I want to hear what Sanjay says. Then I'll go.
So it's not our core area, the LA, but I always say there's the right price, right? So if it's a risk, it's a negative population growth or whatnot, it's a risk that we price in. So
right.
So it really comes down to the deal. Nothing, not a flat no, but we'd look at the deal.
Okay, cool.
Let me add to it. So I'll give you 3 answers: as is, and to be, and what I feel, right? So as is, we're not designed to be in a California market, right? If you ask me. And now to be, yeah, if we find the right partner, we're there. At least we can bring in the debt and the know-how, and we can bolt that on the location expertise with the right partner. And that's the first deal. Then we can bring in the equity afterwards. That's to be, right? Which is why we're open to take a look at it, right? And then what I think, right? Whenever someone is mature, have a lot of equity to deploy, they by design will take a look at California and New York market. They will just do it. As much as we talk about it's people moving out and it's a blue state, you need to think about the other way. We need to think about a little bit more contrarian thinking. People moving out, but they're moving out the middle class. Money in Texas is the most expensive because I sell oil or I sell my work hour every single day. And in California, it's cheap. Today I'm broke. Tomorrow I got a $10 million company. The after tomorrow I sold it for $15 million. And I'm filthy rich, right? So the
Right.
expectation of the money is a little bit there, and that's where people go there. It's not for the middle class where I work, make $300,000 to $500,000. I am broke, right? Same for New York. It's you if you're mature, if you have a lot of money, you go buy New York. This downside is zero. New York is New York. It is the place to be in for everybody. Now, when you make that 200, 300 grand, you pay rent for $1,500 for a one bedroom, not a one bedroom, like a studio.
Yeah.
You just can't leave, right? So you move out. So I still think those markets are fantastic market. We are not designed to be that market today. Or with the right partners with whatever tools that we have, happy to play in the game.
Okay, cool. I'll submit my deal.
Game.
Somebody raised a hand.
Yes. Madeline, right?
Thank you, guys.
Thank you, David. Glad you're here, man. Thanks for connecting, keeping up with us.
Yeah, Madeline.
Go ahead, Madeline.
Hi, thanks for having me here tonight. This is my first time visiting you guys.
Awesome.
I am in Memphis right now, and I noticed on your country map that you had one little marker in the Memphis area. And it's living here, it's not an area I would invest in. I'm relocating to San Diego in June, so gonna look at some different stuff. But I'm just curious as to what you see in the Memphis market and why you made an investment here.
Mike, you want to take that?
Yes, so actually, I don't think we made an investment in the Memphis market. We have underwritten, we've put in some LOIs.
Oh, okay.
Some things in the Memphis market. And around like the Arkansas, part of the Arkansas side. And we've done also some, some proposals in Little Rock and North Arkansas as well. There's parts of Memphis that, are good. Just, I think, there's areas, and we use a map, a view of a map called, if you guys look it up or use it, justicemaps.org. And when you look into justicemaps.org, you can look into a city and you can see where are the pockets that make sense on an economic basis. So it gives like a demographics, but also gives an economic view, and it breaks it into really little small pockets. It's not just like a circular radius of things. It's into certain, kind of grouping geographically in their area. So you can tell like what areas really make sense. So the east part of Memphis over there, there's some places that make sense. And we're, if we have the right partner, this is what also it comes down to. Same with David's question. The right partner, the right location, and the deal makes sense, we would consider, partnering to support that in different ways, whether that's partnering as far as helping on debt, being a guarantor, or, just helping people, understand what they're getting into and working through the process. So that would be that's what I had on Memphis, and generally that applies to a lot of other areas that we look at.
I appreciate that. Would you be willing, I'm sorry, would you be willing to look at a pitch for a property here in Memphis if I presented it? To maybe help me learn.
Yeah, no, and I'd come back to similar with David is we have the deal submission sheet. So, if you submit it through there, we have Brad Pickett and Bhaskar, our underwriter, picks it up. They're going to take a look through it. They're going to run it and get back to you with some questions, talk through it, and then we go to the next step.
That would be great. That would be great. Thank you.
Okay, Schreier, go ahead.
Yeah, so I was going to say that whenever we're running number, again, we don't have any bias. I mean, we know the big markets, right? And within the big markets, we know the sub-locations. And then also we keep an eye on what some of the other markets are coming up. So we felt like the Memphis, Tennessee, some pockets in there, and also there are a couple of counties in Arkansas area. They're showing up in terms of the rent growth pretty strong, even though we're in a down cycle of it. So I think it's called Pulaski County, and that's one of the counties, then Benton County, Pulaski County and Benton County, those two counties in and within the Arkansas area, it's coming out very,
Arkansas.
very strong for some of the data that we have. So that's why we have that thing. If someone shows up, then we're not gonna discount it right away, but we're gonna have an eye on it just for the right set of people. It's not for the project properly. It's more of the team. That do we have a good partner who knows the local market, owns asset, they want to grow with us to at some X million dollars of portfolio in the local market, and that's why we have that as an eye open.
Okay, sounds great. Thank you.
Thanks.
Appreciate the input.
Thank you, Madeline. Prasad?
Thanks.
Yes, hi. Hi, this is Prasad. I live in Seattle area. I'm investing in Washington State and in Texas. So my question is, for a new syndication group, does it, it's always hard to compete with, experienced syndication groups, right? Especially in the top tier cities like Dallas or Houston or San Antonio. So do you suggest kind of like if you're kind of looking at, normal assets that most people look 100+ units, right? 100, 200 unit size apartments. Do you suggest doing a few deals in secondary tertiary markets, get a decent size portfolio under your belt, and then kind of enter, these primary markets?
Sure, you want to do that?
Yeah,
What's
let
your
me take a
favorite?
shot. Yeah.
Yeah.
And then you can spin, you can kind of talk about it, right? So to win a deal, at least to me, someone gotta have some edge on something. Otherwise, if we're running the same model, the same assumption, the same way, our price will be the same, right? So, and given some of those big markets, some of the markets you talked about, it doesn't matter if you go compete at 5 units versus 500 units. Competition is more or less the same. Different type of people in competition there. So that on that note, playing in the secondary tertiary market makes a lot of sense. You go for small wins and you kind of go that way. But on that note, the issue that you're gonna get, at least I feel like we get into all the time when we get into a market where we don't own assets, it's understanding that my belief into the business model is right or wrong. So be very careful as you build, send LOIs or get under contract on a secondary tertiary market, right? And that's one. So I would say, yeah, your play sounds good. We did the same play for Atlanta market. We partnered with some of the folks, Warner Robins and Macon. We have a pretty good stronghold now, have a lot of know-how. That's our entry to the Atlanta market for nicer, bigger deals. So play makes sense. What are you gonna get into? If you follow on the play, it's to me, we believe your pocket will set the stage, what you can buy, how far you can go, and how long you can survive. So build a team or just ask questions, the growth that you're thinking in 2025, how many millions of assets you want to have in a portfolio? Does your team has caliber to take down 2x of that portfolio size? Can your team bring in equity? Can your team, shell in 10% of the equity needed to buy that amount, right? So build a team. On a down cycle, there's a very standard play that we do at Shell at the corporate. Your balance sheet will get you to the down cycle. Equity will get you ahead of the down cycle, and you build your team on a down cycle so you can maximize the up cycle. That'd be my thought. But thank you, Prasad. Anything else you want to add to that one? Are you good?
Yeah, so predominantly like all these distressed deals that we're all expecting, right? So my guess is they'll just be a drop in the bucket, and all the popular groups and very experienced groups will just scoop it in, right? And especially in these top tier cities, right? So the deals that we're going to get like as a newbie will be mostly without much loss to lease and just pretty much operation stuff, right? Trying to squeeze as much as possible from the remaining operations, kind of a thing, right? So as a business, it might probably make sense, like if you want to grow 200, 300 million. I'm just kind of, I'm conflicted, like at times, like when I look at secondary tertiary markets, we can get better deals. right? And so I kind of feel like, okay, maybe we should go buy some of those deals and figure out along the way, right? Rather than just go buy average deals and good markets. Like it's
So that feeling that you're going through, it's very normal, right? Everybody has been through. We struggle with that same thing almost every day, right? All of us. Those feelings are real. I'm not denying that at all. But on the other side, if you're not in the game in the location, the only play that you have right now is play a higher price. On market goes up, doesn't matter what mistake I made. Market gave me the gift. On the market in a down cycle, if it goes sideways a little bit, do you have enough money in your back pocket so when something goes sideways, you can put it into the deal and it can survive, right? So what it boils down to is that try to think about it. It's a tough one, especially who are entrepreneur and who thinks, as all of us, we think we can do it. It's sometimes competition is good, but sometimes competition is detrimental. But collaboration becomes better. We believe collaboration is the way to go now than competition. It's not who gets the more what, it's that your little thing, my little thing, somebody else's little thing put together makes a big thing, get you the edge to get the deal done, right? So look around your things, find out those teams are playing, you like, you feel comfortable, you're willing to share with them, you're willing to work with them, they're willing to work with you. So and kind of build the muscle that way and then go for the deals.
I see. Okay, got it. Thank you.
Right.
Mike got it. So Mike, you raised your hand. I don't know what you're gonna ask.
No, I'm not gonna ask something right now.
You have a comment to it?
No, yeah, I just wanted to make a comment and more questions, we're open to those. I know Sanjay likes to, and I want to kind of stick to a good game plan with our timing, so we're right at a little over 7 o'clock. A few of us will be on here for another 30 minutes after party discussion. So if you got, just continue with any questions, open chat discussion. Doesn't have to be on the topic tonight, just can be anything y'all got. We get as much excitement and action and maybe more out of the after party than the presentation itself sometimes. So feel free to stick around. We're just gonna open it up now, free chat. If you got something you want to talk about or ask, just go ahead and do that, or something you share about, please do. But thank you all for coming out tonight. It was great. I appreciate that. And let us know what you guys got. Anyone?
Yeah, it's the floor. Can you hear me, Mike?
Yeah, David.
If the floor is open, I have a deal I'm looking at right now that I'm trying to figure out so I spoke to the broker today and I asked the questions that Grant told me to ask, which I got a lot of good feedback. The deal, they want 12.5 for a 36 unit in an A+ location in West LA. The seller is selling because they want to be out of Los Angeles and they want to get it off their books. They want 12.5, but the actual broker, I'm meeting with him in person tomorrow in LA, and he informed me that they're incentivized to sell, like what Grant was saying, the urgency of the seller. So basically, I said, would they take a 6 cap or a 7 cap? And he was like, man, just give me the terms. So I sent it over to you what it looks like, Mike, but I wanted to get kind of your thoughts on his responses, because you guys have interacted with brokers a lot more than me, as far as is it a good thing that I wondered if they have no buyers versus do they have buyers? The broker's been doing it for 25 years, so I've just been trying to feel him out. But I wanted to get a feel from you what you thought of his responses, as far as saying, hey, just send over your terms. Is that normal?
Well, terms, he means an LOI, so he's
Right.
assuming that you've actually underwritten it and that you have a position that you want to take on it, right?
I did.
Hold on. Let me get. Sorry. So he's assuming that, right? So that's what he's just talking about. Your you know, is if the market or if the deal is on market, you know, did they provide a full set of rent rolls, a full set of the T12 financials, or did they just give you an OM with like an estimate of the price? I don't want to go through it right now, David. Just wanted to know, like, so I want, because we want to, if we try to go into underwriting it, it'll probably get into too much detail, right?
Right.
But just the concept of how the broker approaches things and what that may mean as to, is the seller really a seller, or has the broker, sometimes what happens is the brokers will go out and they'll get a listing, which means that they contacted a seller and the seller said, yeah, I'll sell for the right price, but it doesn't mean they're really a seller. It just means that they are going to let the broker go fish for them and see if somebody comes up with something, and they may not have any like information they even shared to the broker. Like he's out there fishing to see who's got interest. That's sometimes what happens, right? Regardless of the broker, because that's part of their role. Part of their job is to find opportunities for people to make, or find opportunities for people to make offers on. So there's different ways that it works in that scheme. Sanjay or Schreier, you guys deal with a lot of brokers as well, you know, so I'm just really giving you more of the context, David.
Right.
I think of the expectations and what they may be looking for rather than the detail into that.
And never forget, the broker works for the seller, he does not work for the buyer. So he is there to tell you anything to be a buyer. Brokers work for sellers. That's where they make their money.
Okay, cool.
Sanjay, you want to add it to it a bit more? He dropped off or just still there?
No, he's there,
Okay, cool.
but he's muted, I think.
He's talking to
He's
himself.
muted.
But,
You're still muted.
ah,
Oh,
technical
sorry. Yeah, no. I was saying no. This is good. That's the spot on. So nothing else
And
to add.
yeah, so David, did they have a full set of all the financials?
Well, I have the OM. I can ask him. I asked him for the rent rolls this afternoon, and he's going to send those over, and I'll see him tomorrow.
It's the T12, which is the trailing 12,
Okay.
is something else you want to ask. So it's kind of that's having kind of the knowledge of what things mean. So the T12 is a trailing 12 financials, P&L, basically your profit and loss statement for the last 12 months. So that and the rent rolls will, and
Yeah.
your assessment, drop it into the deal finder, not the deal finder, into the deal submission, and then we'll get a look at it with you together. I don't think you have to worry about it running away tomorrow. It's probably going to be there for a while. We'll get a chance to look at it with you. And I think more the process of, this is for everyone really. We've been working with a few people for 6 to 9 months, and we haven't still done our first deal, but it's more about the interest, perseverance, and then continuing to bring deals, looking at deals. It doesn't work on the first one, right? I mean, it doesn't always work on the first one, I should say. Sometimes it might, but it's us building up the relationship and also building up like your knowledge of why or why doesn't that make sense, and why we maybe don't want to go together into that area or that deal, or how do we continue to look at different markets. So this is really for everyone on here that is thinking about or bringing deals. And there's another question in here I saw, was the thing, which strategy has been most effective for finding deals?
That's a hard one.
Anyone
I
else?
can,
Jasmine, you ready to answer?
yeah, Jasmine, you try that one. Then we'll see.
Mike, thank you for your help. Thank you,
Hi,
guys.
David. Thank you for being here, man. I appreciate you, really. Jasmine's not answering. Go ahead. Oh, you're muted too, Jasmine. You and Sanjay have the same problem.
And let's see.
Okay, there you go. Okay, can you hear me?
Yeah.
Okay, what was the question again? Sorry.
The best way to find deals, the best strategy to find a deal.
Oh, okay. The best way to find a deal. Sorry. Definitely, having connections with brokers, building those relationships with brokers and partnerships. It's so limited what we can do on our own, but when we have the right partners, people who are looking for the same deals that we are, is just exponential, the growth.
It's market is very unfair, and one of the biggest unfair thing you can have working on your side is the relationship. That across everything, realtor channel, GP partnerships, and one of the things that shows up here is that how long we have been in the game and how many people we know and how many people know us. That shows up. Just talking to a broker, looking at the 5 deal posted on LoopNet, posted on the website, and getting a deal out of it, it is extremely unlikely today. And then talking to lenders, talking to brokers, talking to other general partners, talking to someone who has equity but looking to deploy, talking to someone who has a balance sheet looking for equity. It's a whole gamut of things that all has to go in a multiple markets, multiple asset class, multiple location. Then you source out the deals. Because it is tough, David, your point, that broker is looking for best person to sell the property to. He has been in the 25 years, right, the game. So he knows who's not going to be able to buy it, who's going to be able to buy it. That's his job, right? And partnering with the team and having the right talk. And again, that is different on when you look at a $60 million deal versus that being different on a $20 million deal, right? So your skill set, your LOI, the whole thing has to come together. So using your example on Jamal's question, there is not a strategy. We talk to everybody, we look at everything. We have lots of different channels that we talk to, and every channel requires a different kind of expertise, and we kind of play with that to source the deals.
We and some of our other, we've got some beginner type of things we do also that we talk with people about, some early strategies around. I mean, everybody talks about like, hey, how crap like LoopNet or Crexy may be, but you actually can, there still is going to be a deal on LoopNet and Crexy. Start there, start underwriting deals. So you always will have deals to underwrite. And what happens when you start signing up for things, LoopNet and Crexy, you sign a confidentiality agreement, you get into the broker's database, now you're going to start receiving all of their deals. So you'll get a deal flow going whether you really designed for it or not. So that's just some other like early strategies to apply.
Robert has his
100%.
hand up, plus there was 2 new questions put in the chat.
Yeah, thanks, Trevor. I got it. Hey, Robert, would you like to go ahead?
Yes, thank you so much for hosting another informative webinar. My question is just your preference. I'm up in Minneapolis, Minnesota. It does not have the best market data, which is why I've been sourcing deals in Phoenix and Texas and North Carolina for a little bit. But is your preference to have essentially boots on the ground for your operation and finding people in local markets that can perform that role for you? Because if I send you a deal in Phoenix, with assumable debt, decent property, all that good stuff, I've spoken to the director at the brokerage. I'm in Minneapolis. Does that help you at all, or would you rather have me find something where the numbers work locally? That's about where I'm at.
Okay. So I heard a couple of questions, right? So every deal, the value chain of a deal has like at least 2 or 5 different buckets, right? One of the bucket is what we call a deal sourcing. But then within the deal sourcing, Robert, I'll give a long-winded answer. Within the deal sourcing, it's a big stretch. typical, usual definition of deal sourcing is, I found the deal, I emailed to you, Robert, hey, Robert, that's what's in it, and how do we partner up? For us, that is a part of deal sourcing, because once I send the email to Robert, he has to spend gazillion amount of time to underwrite it, and then talk to lender, then talk to equity partners, then look at the, get some bids out of it, and then talks to me, goes out there, shops around, and then comes up with the price. After the price, he got to go negotiate for a LOI. After the LOI, he got to go negotiate for a PSA. Once the PSA is signed, deal sourcing is finished. It's the whole work. So for us, first question, let's see, and us, we're going to work together. Let's role play. Question is, Robert, from your skill set, how do you want us to partner? And you say, hey, I want to find deals. So we're like, okay, that's fine. It doesn't really matter for us where you go to, because we are there. And if you say Phoenix works out for us, fine. So in this particular case, hypothetically, you say, hey, I found a property in Phoenix area. What we're going to do, we're going to call a partner with us. We are doing a deal in Dallas. They had 12, 13 assets in Phoenix. We'll say, hey, Bruce, I underwrote it. This is what I think. Can you underwrite it independently and come back? Let's go debate about the outcome, right? He's going to underwrite it, and then he's going to talk about it. Now, which is slightly different, being boots on the ground. Boots on the ground, it's different than I own and run assets at that asset size, so I kind of sort of know the area and the subculture of the street, right? And that's how we kind of go back and build the team. We kind of go. It gets really technical about, the usual term, boots on the ground. We ask the question, boots on the ground for what skill set, right? Then can I source the deal? Okay, we're going to source the deal, but what category? Then that's where we start. But over time, our goal is to grow the partners, and we grow. So we take the skill sets as fast as we can to get to wherever that someone wants to get to, right? That's how it is. So yeah, short answer is Phoenix area, Texas area, it doesn't, we're okay. We're independent. We don't have any feelings for it. But then we're going to ask, and I would say, keep an eye, if you go to broker route, whoever has better relationship with you, play that card and see if you can get a deal out of it.
Yeah, thank you very much. I'm looking forward to finding out the details about your mentorship in the near future. Thank you.
That'll be awesome. Next week, actually, I think we're planning to do a webinar on it next week to kick that off as well. I'm going to share something quick, and I'm going to kind of address one of the questions around the size of a deal. Sanjay, if you're still around, or Schreier, take a look at the question on the cap rate discussion one from Rosh. So people talk about like finding a deal and partnering. Y'all see the screen with the spreadsheet?
Yes.
Yeah, Mike.
So these are deals that we're underwritten and kind of where we are. But the idea I want to give you is, I'm going to scroll through here, is how many deals we've gone through to get to the deals we've done. And this is that we probably didn't, these are just the ones that we captured, that we actually went through a detailed underwriting process on them. And this is just about probably 8 months of work, maybe, Schreier, 8 or 9 months, probably, I guess.
Yeah, roughly.
And here's when I get to this piece, just to give you some ideas of some things. What we've underwritten, $1.8 billion worth of assets. And we've gone LOIs on a few of those. We've then gotten accepted LOIs on a few, and then we've gotten under contract on a few less of each of those, right? So we've missed a lot of deals. Maybe those, everybody says those are the best ones. Our best deals are the ones we lost. But we also, are under contract on a number of deals, raising equity on those. And we have LOIs in with partners, not just us, but with our partners, or how we're working on things. So just wanted to share that. And there's a question about like how, what size of an asset would you do? And I think it's, let me stop share there. So I just want to get some context for people about, like, we go through a lot of underwriting, and it takes time to go through the underwriting. but it also, that's the only way you're gonna get to really get to the deals you want. Doing what size of units would we, or what size of properties? You know, depending on the location again and how it would work, you know, we've done properties that are partnered with people with properties that are, you know, really it's somewhat the unit size, the unit count, but it's also the value, you know, so probably, you know, looking at something probably starting around 3 million up, you know, a first deal with somebody that they're going to be operating it, running it, and we're going to be supporting them. The first deal, you know, I think makes sense around you know, probably a 3 to 7 million, maybe dollar deal, you know, and we've done that with a number of partners. The properties in North Carolina, we did that with, and now we're with that same partner. We've seen them operate now for about a year. We've seen how awesome they are, and we want to do more deals with them, and we're doing deals with them now that look like, you know, $20 million deals. You know, we're ready to step up. So it's just a process that we go through, and it's, remember, this is a long game, not a short game. So Sanjay, you were going to jump in, and I've been dominating here things a little bit, so I'll shut up for a while.
No, that's good. I was going to answer a couple of these questions. Does massive capital permit lowball deals? If not, why? If yes, your strategy and negotiation tactics. So, you know, it's funny you asked this, because a lot of people think that there's a seller who's wanting 20 million for their property, and you go submit a 15 million offer, they will magically, they might accept it, or there may be some scenario where they may be willing to consider it. But think about this logically, right? 20 million to 5 million is a big deal. If they have an investor base, they have a fiduciary duty to do the best, right? And if they don't have the investor base, they may have bought a property at 12, 13, 14 million. They're not making a lot of money. They may have spent the money, right? Why would they go from 20 to 15 million? If the property is on the market at 20 million, they'll go to 19 and a half, 19, 18 and a half, 18. Who knows? They may find a buyer at any of those prices between 20 and 15 million, right? So that's where hardly ever a big difference in asking price or seller's expectation and whatever your underwriting comes up with, you know, if there's a big difference in that price, your underwriting and the seller's expectation just doesn't work if it's too far. So it's a waste of time for everybody, and quite honestly, just doesn't work. Our strategy in those cases is, you know, if we're really far from the seller expectation price, we'll call and say, hey, look, I'm coming up here. What am I missing? Tell me. I'll share you details. I'm writing this rent. I'm writing this. Here are the details. Show me or tell me where are we different, and either they'll convince me to something different, or I'll convince them to something different, or we'll say, well, yeah, you have this rent assumption or this assumption. I don't agree with this. That's where we fall apart, and it's not going to work, right? And so that's a kind of a thing that we look at, and I'll do our underwriting that way and negotiate based on that. So, Shrai, you want to add anything to that question before going to the next the cap rate question?
No, no, I mean, for us, high, low, that term, it doesn't, I mean, at least I don't use that term. The term doesn't make sense to me. I think is let the number do the talking most of the time, right? We want to do deals. That's what we're in the market, spending the time. And if we can make the number works for everybody. So I'm in the court with Sanjay. Every time we underwrite it, we solve for basic parameters. And if the number goes around, we make the offer. If the number doesn't go around, we call and ask what happened. And, you know, there's oftentimes you'll see broker will say, yeah, it doesn't go around, but this is what seller wants. What can I say? Yeah, I mean, you know, example, we had a property, we took a look at it. Seller was asking for 17 million. didn't give us all the information. We are the 14 million, gave us a little bit, went up to 14 and a half. Then they said, give him money hard. We said, we'll give it to you in about 7 days for due diligence. But since you want the money hard, $250,000, give us all the information now. So we fully underwrite it. So we went in and ran the model at a 80 somewhat percent, 83%, 82% occupancy, because that's what seller said. After we walked the property, seller sent the updated financial, it's at 54% occupancy. The $14.5 million property at best is $9.5, $10 million. Is it me? No. I would like to pay them more, but I have to underwrite at a 10% interest rate for 3 years. On a 15% deal, 10% interest rate, you lose 20, 30% of the price right away. So it is what it is at some point in time. Back to you, Sanjay.
Yeah, no, that's good. On the cap rate question, the question is, if the cap rate is lower than the interest rate on debt, does that mean using leverage in such a deal would bring returns on equity down? So using debt in this scenario doesn't make sense. So theoretically, no other variable, you're right, that you buy a property, cap rate is your return on your property bought cash. And then if you borrow and pay higher interest than your cap rate, no other variable changes, you're absolutely right. But most properties, what happens? You increase the rent, you increase other income, you decrease your expenses, you operate it better, you do all kinds of things, right? And that's where it may still make sense, where your cap rate may be lower than your debt, and almost always is, but your NOI goes up. So that's the difference, right? In your equation of your value of a property is NOI divided by your cap rate. Yes, cap rate is lower than debt, but NOI goes up significantly to increase the value higher. Hey guys, I gotta drop off 7:30 here. I'll let you continue. Thank you everybody for joining, and look forward to meeting you in our events as we start, and enjoy the topic.
Sanjay, thanks.
Thank you,
I'll
guys.
answer the last two. Then I got to break loose in 10 minutes. So I agree with Sanjay, right? Cap rate is always behind the interest rate, but you need to have a clear path of value add. Then another question was Ahmed, Safwan was asking, okay, what is the number of units? If you send us 20 units, for us, most of the deal that we underwrite, it falls out because of the skill set needed to offtake the deal and by the team that we have. So short answer is yes, we'll take a look at it. And long answer is, before we get to the deal, it's understanding, what you want out of a relationship or partnership, and your growth mindset, or what, your time commitment and your time availability. And then we put the deal in the middle and we kind of go. And then we test it. Yeah. So answer is yes. We'll take a look at it. About the spreadsheet. That's a 9 months worth of work for the data point. I'm happy to give you a template that you can use, not the data inside. That's the answer.
You can create yourself. It's not easy.
It's a 9 months worth of work. We could have some arbitrage, right? But happy to share our thoughts on it and the Excel file.
It's very easy to create.
Oh, she sent it private to you, I guess, so.
Okay. Oh, sorry. My bad. Tracy, it's been fun all the time talking to you. What else? Mike, do you see any other questions?
Balaji, nice to see you on here again tonight. So I just wanted to
I haven't seen you
shout
for a while, Balaji. I thought you took a vacation 6 months out.
Yeah, I was on a cruise and then we went to Vegas. So yeah, a lot of things going on. But good to be here. Yeah.
Good.
Thank you for joining us. Appreciate it.
And I saw Lisa, I don't know if I don't want to shout out Lisa. I saw Lisa this weekend. Lisa's from Puerto Rico. Glad to have her on. Ben Johnson as well. Ben, glad to have you on here from Atlanta. So
thanks, Mike. Appreciate it.
no, good. Go ahead, Lisa. Go ahead.
Hi to all. Happy birthday, Mike. I didn't know it. It was
I tried to hide
amazing this
it.
Why? We
Yeah.
have to celebrate that.
I'm getting better. We're gonna party next year. Next year's gonna be a party.
Woo! It was a really amazing weekend. It's a really good opportunity to get together, to see each other, and keep learning. And also, it's a great opportunity to increase your level of energy to do something. You know, we need this because as soon we finish that events and you go back to your home, you don't have that same kind of energy here. And I love it. I love it. And I enjoy seeing you and learning from you. So thank you.
Thank you. Thank you. And thank you for the birthday wishes. Everyone else also, I appreciate that. And thanks, Lisa.
Yes.
Dan.
Happy birthday, Mike.
Earlier today. Hi, Dan. Nice to see you again.
Yeah, yes, sir.
Twice in one day.
That's awesome. Sorry.
Hey,
oh,
hey,
Ben, go
Sanjay.
ahead, Ben. Yeah, go ahead, Ben.
No, I was just saying hey to you and Sanjay.
Sanjay
happy
just
birthday.
stepped out, but hey, thanks for having. We've met with Ben this morning as well, so it's great to continue to connect.
Yes.
Hey,
And
Mike.
I don't know, Senate, are you on or you? I just don't know if you're listening or just kind of not able to talk. I just want to.
Yeah, no, I'm here. Sorry, I was on mute.
Okay. Hey, I don't know if you want to, throw out anything, just introduce yourself a little to some of the people left around here right now. And Senate's joined us and getting things geared up for the education package platform coming out.
Yeah. So I apologize. First, I'm not in the best spot, like not the best lighting here tonight. But yeah, I'm Senate Eskridge. I'm going to be working on a lot of the coaching and the mentoring program. I've been in real estate since 2009. Done 12 multifamily deals so far, and looking to be able to share that experience with all of the group. So happy to be here.
Senate's a long time, so he's a member of Jake and Gino. I don't know how long, but I know he coaches there also. And for those who aren't familiar with Jake and Gino, it's somewhat along the lines of Warriors, Rod Cliff's kind of programs from what I've seen. It's and he's also, I didn't realize how long, but been a member of Raise Masters for quite a while. And you've capital raised quite a bit over your time as well, I think, right?
Yes, absolutely. Yeah. I've say that I've helped over 100 investors invest. So that's it's a fun time. I love capital raising. It's one of my specialties. Also finding deals and the whole contract to close. Those three areas are my specialties, but being a coach and well-rounded and can work in all aspects of the business. So happy to help. And one of the biggest things I'm really excited about with our educational community that we're building is we've got access to so many different mentorship groups, right? So people that are from Rockley, people that are from Grant Cardone, Sumrock, Jake and Gino, Raise Masters, and we have all of this knowledge that we're kind of tooling together to take the best of each group and make it our own and share it with all of you.
Yeah, and I think the other cool thing is that we plan to, depending on what levels you get in at, to make it, there'll be a lot of interactive, but also an opportunity to really be a kind of a working lab environment. I almost call it, where you sit in our calls, our regular, our weekly, daily calls that we do, depending where you come into the program. So it's going to be pretty cool. Excited about it. We've actually, been laying it out for quite a while now and ready to get rolling. So thanks a lot, Senna. Glad to have you here and excited for what we got going.
Happy to be here.
Mike, I gotta bail out.
Okay,
So,
sure,
I'll go
thank
break
you.
my fast.
You
Thank you
should have
so
already
much.
been, you should be,
I
yeah,
gotta
I
go
was gonna
too.
say, you're about ready to break fast, or you should have. already.
Thank you, everybody. Have a good night.
Thanks, Shire. Have a good.
Thank you.
Hey,
Have
everybody,
a good
thank
break,
you.
man. Fast break. Thanks, guys. So we can probably call it an evening here, and appreciate again, everyone. Let's see, why do you prefer A and C class assets? I don't know if Jamal's still here or not, but so I don't know that we prefer A and C class. We started with it's really we prefer the deals that we're able to get and that actually make financial sense. So class C, sometimes we got into a few because they were opportunities that came to us, value adds. The class A property, one that we actually own, actually it came to us through our what we call the deal doer machine, which is a partnership we also have, which will be part of our education platform. And it came through that direct to seller. It didn't come through a broker. We found it off market, direct to seller in Dallas. And it was just an awesome deal. And it's cash flowing great. I mean, it was, you know, and it, again, so we don't have any work to do there. It's sits in a, you know, beautiful little spot in Rockwall area up in Dallas, and it's cool. So our buy bucket, I'll say, if you had a buy bucket for massive capital operated by massive capital right now, it is actually more into a class B is what we would like to be buying. So our last big asset we bought was class B in Dallas, which that we acquired last year. A lot of our partners are in here with us on that. That was a $60 million deal there, 419 units, class B, value add again. So that, so it really is, what is the economic value and the opportunity to add more to return to the investors. I mean, that becomes the bottom line, is like, if we can't make a good return for the investors at the end of the day, then it doesn't make sense to do it. But again, our buy bucket right now is class B, 200 units plus, is really where we'd like to be value add type of assets, mostly in Texas for us right now. Operated by others, I think we're still open to class C and class B. Smaller deals, as I mentioned, could be 30 units, could be 40 units. You know, just depends on the situation. All right, thanks, guys. I think that answered that. So I think I covered all the things, and thank y'all. Rochelle, I'll give Tyrek a call tomorrow, so just tell him hey. And thanks again, everyone. Have a good night. Oh, I'm sorry, Dan, I missed. Did you have, Dan, sorry, did you have something you wanted to shout out?
I don't think so. I was
Okay, your hand was up, so I didn't know if you were trying to share.
Oh, no, I was just sending you a thumbs up. Thank you.
Oh, I got it. Thank you, Dan.
You're welcome.
Have a good one. Good night.
Good night.
All right. Good night.
Natasha. Good night, Natasha.
Good night.
See you.
Happy birthday.
Thank you. Thank you. We'll have to connect sometime.
Yes, definitely.
All right. You're in where are you? You're in Alabama, or?
Yes, I'm in Alabama right now, and I just came back from New Orleans. Have to make a little quick stop in Atlanta, and then Augusta and Miami, and then I'll be back.
Oh, okay. Yeah, I'm gonna be back in Atlanta. Which part of Alabama are you, north or south?
Birmingham.
Okay, because we're gonna be back in Atlanta in a few weeks for a meetup there. Like the third Friday of April. I don't know if you're around, if you want to join us would be cool.
Okay, I'll definitely check my schedule. I know if it's like the 26th, I think one of my friends has a wine launch that she's doing in Houston at the time that I'm supposed to be back there. So yes, are you normally in Dallas or?
I live in Houston.
Okay, okay. Well, for sure. Yes, Houston. Once I'm back there, I should be there for a while. I've been gone for a while since December, but
Okay.
I should be back once I'm there for at
Okay.
least a little while.
Okay. The meetup is 21st. It's the 21st in April, 21st of April. It's a Friday.
Okay, in Atlanta.
It's in Atlanta, yeah.
Okay, I'll definitely check and see if I can't make that one.
Okay, yeah, we're gonna be there. At least I'll be there. I don't know if any of the others will be coming. We're partnering with them for longer term plans for that. We'll probably, Candace, hopefully see you there as well.
Yeah, I plan on being there. I will definitely try. Sorry, I missed the last one. Happy birthday too.
Thank you, Candace.
I saw it everywhere and I thought I pressed the message and it didn't go through. So I apologize.
No worries. Thank you.
Happy birthday. We should make it a whole month occasion.
All right. So look forward to seeing you. Hopefully, Natasha, see you guys in Atlanta, if you can make it, April 20th.
20th, 21st,
20th.
20th. Okay.
Oh no, 21st. I'm sorry, 21st. It's a Friday. April 21st,
Okay.
Friday.
I'm gonna put it on the schedule and I'll definitely let you know and confirm.
Okay. Do you have my number? I don't know if I have yours or not.
No, I
Let me
don't think so.
Let me put my number here in the chats,
Okay,
and then you can, if you want to.
I'll send you a text message immediately so you'll have my number.
Okay, there you go. There's mine.
Okay.
Hey, Mike, is it the same location or we don't know yet? Same place?
Same
it was?
location in Buckhead.
That's a wonderful place. Okay, thanks. Y'all have a good night. I'm gonna go ahead and log off, okay?
All
Thanks, you
right,
guys.
good night. Good night, y'all. Thank y'all.
Good night.
Lucian, Jesse, thank y'all for being on. Bye-bye.
Bye.
Did you get the number, Natasha?
Yep, I just got it.
Okay,
Okay, and I'll send you a text message now.
perfect. Okay,
Thank you.
thank you. Bye-bye.